Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Kate Campbell, welcome to this episode of the Australian Finance Podcast. How are you?
I am doing very well, Owen. It's just started raining outside, so a perfect time to talk about dividend investing and stocks with high dividend yields indoors today.
Yes, it is. They keep you warm. When the stock market might be falling, the dividends still hit the bank, and that's what makes them so special. So today we're going to talk about 5 companies, and I think I'm going to cop a bit of criticism, at least on YouTube and wherever this podcast goes out. People might be like, "That's not a dividend stock," when really I'm going to explain to you some of these companies, and we're going to share the screen for those on YouTube. And otherwise, if you're just listening on Apple or Spotify, we'll walk you through it. We've got 5 different types of dividend plays for people, Kate.
Now, Owen, I know people are interested in the idea of getting dividend income from their portfolio and investing in stocks that pay you something without you having to do any work. Is it too good to be true, or is this a real thing?
I think it's definitely not too good to be true. I remember when I was younger, like early 20s, and just discovering dividends, I thought, I get like $2 or $3 in my brokerage account or as a check that's attached to some weird piece of mail. And I thought, oh, this is not really that meaningful. But no, it is. And it becomes really meaningful as you get more money. And if we look back over the Australian stock market over the long term, like the ultra long term, if you got to say a 10% return, you might kind of expect that about 4% comes from dividends and the other stuff is the growth. So although we look at the stock market as this place where you can get long-term growth, it actually provides income as well. And that's quite different to, say, property, which is the other major investment in Australia, which tends to grow, but it doesn't tend to produce any income, at least not when you consider the costs associated with having a loan and those types of things.
All right, Owen, before we get into the juicy stuff for this episode, can you just give us a quick explainer on what a dividend is for anyone that's new to investing listening today?
Yeah, probably the easiest way to think about it is shares can grow, which we talked about, but they can also release some of the profits back to you. And so if a company like Telstra makes a good profit this year from selling mobile phone plans to people, it might have some money left over and it can decide, its board of directors can decide to send the money to shareholders, and that's called a dividend. And the kind of the probably the closest example is like a term deposit or a savings account. You don't actually have to do anything for this. It just appears in your bank account, or if you haven't provided your bank details to the share registry or to your brokerage account, you may actually receive an old school check. There might be a check attached to a letter that you receive. So always check your mail and go into your what's called a share registry, which is the place where you kind of keep a record of all your share investments. We've got previous episodes on that, and that's where your money will then be directed to, say, like a bank account or something like that. The key thing to understand is in Australia, you receive dividends because the board of directors of the company determine that they want to pay back some profits as dividends, but they're not obliged to. So not every company or not every share pays a dividend. And that's really important to understand because even if a company is paying a dividend this year, it may not pay it next year. And you might ask, well, why doesn't it do that? And there are a few reasons that might happen. One of the reasons is the company's not, doing well enough to afford to pay you a dividend. That's the first obvious reason. Second reason is a company might choose to keep the cash that it is creating, the profit that is made, to reinvest for future growth. And that's really, really popular when a company is still early in its journey, because it will want to keep that money in the bank so it can buy a new factory, open a new store, employ more people, those types of things. So that kind of explains how dividends are paid, why they're paid, and how they're kind of attached to the long-term growth of a business.
So generally, a company would have to be quite large to decide to pay out some of its profits rather than just use all of that money to keep growing the business, which you would expect out of a smaller company.
Yeah, typically, but there are small companies that are really good at what they do, and they're probably not going to grow that much. So size is not necessarily the key determinant. Probably what is the key determinant, is kind of the life stage of a company. So some companies can still be small, like basically every company's small relative to Commonwealth Bank, for example, but it can still pay a good dividend. So one of the best dividend stocks in Australia over the past 20 years is a company called ARB Corp, which trades under the ticker symbol, the stock code ARB on the Australian Stock Exchange. And all that does, or at least it did when it started, was make bull bars. Started in a garage and created bull bars for 4x4s, and now it's an international company. But even though it has grown a lot and it's still growing, it's probably one of the most successful companies on the stock exchange for dividends. It's still nowhere near as big
Mm.
as, say, Commonwealth Bank, but it's probably still, it's probably on its way to maturity, and it can pay dividends. Even in early days, because it was profitable, it could pay dividends. And even a good example of this might be like your local fish and chip shop. It's run by a family. Chances are that that is actually a company. Like they've set that up as a company. The fish and chip shop does well this year. It can pay a dividend to whoever owns that fish and chip shop as well. So it doesn't have to be a huge company, but yeah, you're generally right in that what we call blue chip companies, they tend to be the ones that people go to for dividends. But hopefully today I can explain why you should look at other types of companies to blend in there as well.
We've spoken on the show before that you shouldn't just pick a company to invest in based off its dividend return. So, for example, you see a company and it paid 10% out to shareholders this year. You don't immediately want to just jump into that company because it might not actually be a great company under the surface. Are you able to talk us through some of the attributes of a good quality dividend stock?
Yeah, I think a lot of people, Kate, you're right about that. A lot of people's their first instinct is to compare shares like they would compare a term deposit. Like if you just went to the Commonwealth Bank website and the National Australia Bank website and you looked at the term deposits, you would just pick the one that has the highest yield or interest, right? But it's not the same with dividends because there's other elements that come into play, like how fast that company is growing. Because if it's growing faster, you might get more dividends in the future. If it's a risky company and it could go out of business, it might not pay a dividend at all. So in that case, you probably want more income potential for the risk that you're taking. And so it's a little bit different than just picking the highest one. That is what we call a yield trap, a dividend yield trap. People get sucked into this thing and then only to realize that, hold on a second, that's not right. It's not going to pay any dividend at all. And I've ended up with a dud stock. So what I would say to people is make sure that you approach dividend investing the same way you would approach any share investing. And you can go to our website to find out more about the Rask philosophy. But here's how I think about it. You'd still want companies that have a competitive advantage. So you'd still want companies that do something better than the competition. We call this a competitive advantage or a moat because it's kind of like the ring of water around a castle. It protects the castle. A good example of this might be, say, a company like McDonald's. McDonald's just creates burgers, but at the end of the day, it charges more for those burgers because it's got better systems, the flavor is the same, the culture is like the best of any fast food chain, and so on and so forth. So it is able to increase the price of a Big Mac, serve the same Big Mac anywhere in the world, and people still pay the price, which means it has some sort of advantage. The next thing I look for is growth. And the reason I mention this is you want companies to grow and you want companies to grow at different, I guess, stages in their life cycle. So even if you're investing for income and you want heaps of, income and passive income from your portfolio, you don't probably want all blue chip companies in there because chances are you're investing for 5 or 10 years. Now, if you just pick the biggest winners of today, in 3, 4, or 5 years, the reality is that those companies might not be the winners anymore. So you want to mix in some growing companies with some mature companies. But regardless, one of the risks that people fall into here is they might buy the biggest, best dividend paying stock, at least from historical standards. So say like a Commonwealth Bank. Commonwealth Bank pays a great dividend and it's known to pay great dividends. But the reality is over the past 10 years, Commonwealth Bank's profits have only gone up about 10% over 10 years. So in the entire 10-year period. That means that it's not able to pay a bigger and bigger dividend sustainably. So what you want is companies that can grow the profits and therefore will eventually increase the dividends. A good example, if you want an example, is ARB, which I just mentioned. Another thing you really want in any company that you invest in And as a shareholder, that's exactly what you're doing. You're investing in a company. You own part of that company.
Mm.
You're giving that company effectively your money to grow for you. You want good management teams. These are like the CEOs and the chair people that oversee these companies. If you want an example of a really impressive company from this perspective that has good management and a good board of directors, is a company called Washington H. Soul Pattinson, or Solpats for short, is how I'll refer to it. Trades under the ASX stock code or ticker symbol of SOL. Solpats has been run by the Milner family, or like the descendants of the Milner family, for over 100 years, and it's stronger than ever. It's about to become what we call a dividend aristocrat, which is a company that has been able to increase its dividend for decades upon decades. So this is a company that continues to pay bigger and bigger dividends. And so one of the shortcuts that I like to do is I tend to just find companies that are run by the founder, that are run by a family. So it might be like the niece or the nephew or the grandchild of the original founder, because those two types of managers tend to manage it better for the long term. Finally, one of the extra things that I always look for is I always look at the kind of the sector that I'm investing in when it comes to income stocks. And the reason I do this is that I want to invest in industries which are growing. And this might sound really simple, but there are some industries where it's really hard for companies to be sustainable. And there are various reasons for that. But a good one, and you'll see that with the companies that we're about to talk about, a good one is healthcare. Global healthcare spending is on the rise. The kind of the makeup of the industries are really interesting as well, like the different healthcare subsectors, in that typically what you have is a regulated industry, but you also have companies that are producing products which are regulated. So once they're in existence, they're kind of protected through patents or copyright or just different types of legal protections, and intellectual property that can generally mean that they charge a bit more. The government pays the bill half the time, and so on and so forth. So you tend to find really good companies in that industry. So just to recap, we've got competitive advantage, long-term growth, good management, and choosing your sector or industry wisely. If you go to our website, you'll see that there's also commentary around valuation, but I'll just keep it at those 4 key pillars for now.
Is there often the trap when people are looking for high dividend paying stocks that they end up just investing in a couple of sectors? So if you imagine your grandparents' dividend portfolio, maybe they have the big 4 banks, they might have BHP, they might have Rio Tinto, they might not actually have much else. And suddenly most of their money is tied up in only Australian companies and only companies in a few sectors like financials and materials.
Yeah, so that's a big one, because those industries tend to also be quite difficult industries to invest in. So, in those industries in particular, like you mentioned, BHP, Rio Tinto, Fortescue Metals, they all deal in iron ore. In the banks, we have the big 4 banks: ANZ, CBA, CommBank, NAB, and a fifth one, which is Macquarie Group. Um, if you think about those 2 industries in particular, they've done very well historically, and one of the reasons has been that competition has been very, very hard to produce in those industries. So, um, you may be too young, Kate, to remember this, but there was policies brought in by the government which basically protected our big 4 banks here in Australia, so much so that international competitors like HSBC, you might be familiar with, and other global banks have basically found it impossible to compete with our local banks. And so those banks, what we call incumbents, have done very, very well. But there's not many of those really good companies in that sector. Conversely, if you end up building a balanced portfolio, you'll benefit from different drivers in different industries. So, say if you did have some BHP, but then you blended that with a healthcare company, then you blended that with like a real estate investment company, and you blended that with, say, a supermarket. You do it that way, and you will end up with a really good mix of different types of investments that produce different income streams. And so if one of those industries is struggling one year, which, for example, this year might be iron ore, maybe there's another industry like, say, supermarkets that holds up. And so that's kind of like the holy grail of building a passive income portfolio.
Wonderful. Well, I think we've made the people wait long enough. Owen, what is your first pick for our watch list if we're interested in investing in higher dividend paying stocks in Australia?
Yeah, sure. So I'm going to come out with 2 companies, and these 2 companies, I know this first one has been mentioned on this show before, maybe the second one too. I'm going to put these 2 together, and I'm going to talk to them probably in tandem. But the first one is Cochlear. So Cochlear makes implantable hearing devices. They kind of go into the back of your head and they allow people with severe hearing loss to hear again. And it's quite remarkable when you watch the videos and these types of things online. The company has been around for decades. These devices that actually go into your skull are actually very expensive and they require typically months of, I guess, treatment, therapy, and then the surgeon's time. And then there's recovery and these types of things that happen. And you go through an audiologist who recommends you to a surgeon. That surgeon is trained in cochlear devices, and then that device is implanted. And you probably heard people talk about cochlear devices. What you typically don't hear when you talk to friends or family that may have one of these devices, you don't hear them say, "Oh, my implantable hearing aid," or something like this. You don't hear them use those words. What they always say is "my cochlear."
Mm.
And that's actually really interesting when you think about it, because the name of the company and the name of the product has become synonymous with the actual thing that you're getting done. Even if it's not a cochlear device, people tend to still say that. And that shows you how powerful this brand is. And it's been around, like I said, for decades. It's a true Australian success story. The key thing where people get hung up on this company, Kate, is that the current dividend yield is 1.3%, which to a lot of people, they think that that's not enough to be a dividend stock. And you know, for all intents and purposes, I probably do agree with you. But I think what Cochlear lacks, in much like the next company, what it lacks in dividend yield and dividend payments this year, it will make up for with growth into the future. So Cochlear is building more and more devices that, for example, can connect to your iPhone, can connect to the devices around you and help you hear better, generally speaking. So what Cochlear brings to the table is, yeah, sure, it might be a smaller dividend yield, but in the long term, it's expected to grow. Depending on what you look at, depending on what data you look at, sales are expected to grow between 10 and 15% per year over the next 3 years. And so as those sales go up and profitability goes up, you can expect more dividends. And that's one of the beauties of buying a growing company, is that when you buy it at one point in time, you effectively lock in the price that you pay, but the dividends that you receive per share can keep growing for many years, if not decades into the future. And so much that's Cochlear, trades under the ticker symbol COH. The next company is even less impressive when it comes to the current dividend payments, and there's a good reason for that. Okay, it's called ResMed, and the trades under the ticker symbol RMD. Now, unlike Cochlear, ResMed doesn't pay as much in franking credits because ResMed is actually headquartered, I believe, over I think it's New York off the top of my head. It's headquartered overseas, which basically means that it does do a lot of its business overseas and it's going to be generating profits overseas, which means it doesn't create franking credits, which are just tax credits. But the interesting thing about ResMed and what it does as a business is ResMed is a business that deals in sleep apnea machines. You've probably heard the phrase CPAP, CPAP. These are like machines that might sit beside your bed and they look like a mask that goes on your face, or that is a mask, and it connects to this machine and it helps you breathe at night, and it helps people with sleep apnea avoid basically sleep loss, which can actually over time lead to many other things. If you go back far enough, and in particular last year, we've got the chart up here from marketindex.com.au, Kate, on the screen in front of us. You can see that in July 2023, it was trading at $33 a share. And by 22 of September, it was trading at $21. So what's that? Over 30% fall, or about that, in just a couple of months. And the reason for that is that people started to get spooked, Kate, by the rise of Ozempic and other GLP-1 drugs. So for those of you that aren't aware, these are drugs that help people lose weight, originally for diabetes treatment and these types of things. But people thought, well, if there aren't as many obese people, they're not going to have the breathing difficulty and the sleep apnea, which is often that goes, it's like a comorbidity. It goes together with other conditions. But realistically, what we've found is management have proven to be correct in what they were saying at the time, which is that Ozempic and those GLP-1s have a very defined group of, I guess, target audience of customers that would use those drugs. And even if they use those drugs, chances are they would also use CPAP together, or the market is so big globally that, yeah, they might take some of the customers, these new range of drugs, but the reality is people will still use CPAP machines to sleep better. So, what we've found in this business is that it's continued to grow. It's grown in really unique and interesting ways. For example, it doesn't just sell the hardware, but it also sells the software, which is really, really interesting for people. Meanwhile, one of its competitors also had a massive setback. So that
That
helped.
always helps. Yep.
Yeah, yeah. So not good for the people that would be using those devices, but in for ResMed, it's kind of established itself as the industry leader. I actually think that last year was probably, and we on over on our Australian Investors podcast, we did call this out. It's probably one of the only companies last year that you could probably say, like, hand over heart, this is a great buying opportunity.
Mm.
Not that we like to think about, trading stocks or anything, but it's clearly one of the best companies on the entire Australian stock market, and it was sold off massively for something that was very myopic and short term. So that's ResMed, RMD. You don't get a lot in dividends now, but it will probably make up for that with more growth in the future.
What is the current yield for ResMed?
That's only 0.6%, give or take. One of the things that we should mention to people is that when you go to a website and you see what the dividend yield appears to be, just be aware that that can be wrong, and it can also be calculated differently depending on which website you go to. So, for example, you go to Yahoo Finance, Google Finance, your brokerage account, whatever. What you can find, Kate, is sometimes the brokerage platform will use the current dividend yield, like its estimate of current dividends. Sometimes it will use last year's dividends, a trailing dividend yield, and sometimes it will use a forecast dividend yield. And you've just got to kind of fact check what it is. But over time, you can use other tools like Ticker, which is TIKR, TIKR. You can use that to determine what the long-term dividend yield might look like. I'll bring it up on the screen here in front of me. So if you have one of these types of software tools are like $20 a month. It's really not essential, to be honest, at least not for for growth investors and ETF investors. But if you looked at, say, something like the dividend yield over time, you can see by looking at this chart that since 2021, ResMed's dividend yield has rarely ever gone above 1%. Like it was momentarily last year, as we mentioned, when the share price got sold down. But the reality is that you don't buy this stock for its immediate dividend yield, but for its long-term growth. And that's kind of the key takeaway for ResMed is you're going to get a bigger dividend in the future, most likely. Obviously, it's not guaranteed, but the reality is you get growth to make up for that dividend yield.
Okay, you've started us off with two lower paying dividend shares that are more focused on capital growth long term. Do we have a higher paying dividend share right now to share with everyone?
Yeah, for sure. So, um,
Said the word share too many times
too
there.
many times. So let's talk about. I wanted to talk about these two together because they might be interesting. Some people have read the Barefoot Investor book, and it talks about if you don't have enough money to buy a property, you can use the stock market to invest in the property market, if that makes sense. And that's because on the stock market, through your brokerage account, you can invest in things called real estate investment trusts. A real estate investment trust, or REIT for short, all that does is it puts people's money together and goes and buys big properties like offices, buildings, factories, that sort of stuff. One of them that was made popular through Scott's book is the BWP Trust. BWP, all it does is it owns a selection of the Bunnings warehouse property. So when you go to your local Bunnings and you see the land that it's built on and the big shed, that's owned, well, not always, but that may be owned by BWP Trust. And the way that that works is Bunnings, the business, pays rent to the landlord, which is BWP Trust. It kind of makes sense. Um, Now, we're in this very blessed situation, Kate, in that we can buy the landlord, so we can invest in the landlord being the owner of that property, or we can invest in the business of Bunnings itself. So Bunnings in Australia is owned by a company called Wesfarmers, trades under the ticker symbol WES. And the BWP Trust, the landlord, the property owner, is BWP. So pretty easy to remember. If I was to pick from the two, I would go with Wesfarmers. So WES. Wesfarmers makes about 60% of its money from Bunnings. The other stuff that it owns include Kmart. It did own Target, but those are kind of getting squeezed out now. It owns Officeworks. It owns some industrials business and a safety business as well. And it's really well diversified. So what you get when you invest in Wesfarmers, you get a 2.8% fully franked dividend yield. So that will go up towards 4% when you get franking credits included. Um, you get that dividend yield plus the growth of Bunnings and the complementary businesses that sit around it. And it's kind of diversified. So rather than say ResMed, which is just in healthcare,
Mm.
just selling things to do with sleep apnea, like it sells some software, you actually get a really diversified business that's got DIY home improvement. It's got office works, it's got industrial businesses, it's got safety businesses, it's got some mining exposure. So it's got all of that in one. And that's why people seem to like it, is because it offers all of that in one place. And it's a big company, about $78 billion in total market capitalization.
And Monique told me they do raves now at Bunnings, so,
Do they?
we
Right.
went to a rave at a Bunnings warehouse a few weeks ago.
Wow. Okay. Well, that could be a new business line they're yet to explore. But I mean,
Yeah,
who knows what can happen at a Bunnings? I
there
mean,
was a sausage sizzle and everything, she said.
people can slip on sausage, like the onions on the sausages. Let's be honest. It's a whole thing. It's an institution. But seriously, on our Rask Live show recently, which was last fortnight, we compared Bunnings Warehouse to Home Depot in the United States.
Mm.
Now, Home Depot's like 5 times the size of the entire company. But what was really interesting is that even though it was bigger, its financial makeup was almost identical.
Hmm.
So the same profit margins, the same growth expectations, virtually everything is the same, which is quite interesting when you think about it. Even though it's a lot bigger, it
Well,
is
US is much bigger than Australia, so
well, the population of the US is like 10
mm.
times what it is in Australia. So effectively, you just got a bigger version of the same company. And that's really interesting. And people will rejoice to know that Home Depot as a stock in the United States has done unbelievably well. Like it is incredible. If you go and look at that, the ticker symbol is HD. Um, Go and look at that stock price once you're done with this podcast. HD. Just Google that, and you'll see like unbelievable growth. And that's basically what Bunnings is. It just happens to be buried inside of Wesfarmers.
Yeah. And what's the dividend yield for BWP?
I will get that up right now. I do not have it off the top of my head. So that dividend yield is 4.99%.
Okay.
So so the
There we go.
the key thing to understand is like why would you buy a business like Wesfarmers that gets 2.8% versus 4.99% from the property owner? And again, it comes back to growth, Kate. So you're going to get more long-term growth. Like here, for example, we can see on the page in front of us, in terms of returns over the past year, BWP is actually down 1%, whereas Wesfarmers is actually up 29%. Now, that's not normal. That won't happen every year. But my point is that over time, don't be fooled into thinking that just the stock with the biggest yield is going to produce the best return, because you can always just sell some of your shares. Like if you think about it, if you have $100 invested in something and and you want a 5% return, just sell 5% of the shares and you've got the equivalent return. And a lot of retirees in particular, Kate, fall into this trap. They think, oh, well, I need to find the best dividend stock. No, you can just sell some of the growth and fund your lifestyle that way. It's exactly the same thing. You can even automate that process through some of the platforms and brokerage accounts now.
Ideally, you don't want to be just looking for stocks with a high dividend yield. You want to find a stock that's going to keep growing, but also paying a dividend if that's your focus.
Absolutely, you do. And I'll give you the next company, which I want to talk about. We could probably bring that up on the screen. This is a business that pays a very similar dividend yield to Wesfarmers in that it's about 2.8% plus franking credits. This is Washington H. Soul Pattinson, SOL. I was actually looking at this the other day, Kate. We have done so many podcasts with the senior personnel at Soul Pats over the years. It's actually incredible, and that we've got this exposure, because I think that Soul Pattinson, ASX ticker symbol SOL, is probably one of the best run big blue chip companies in Australia. It So what it does is it's quite different to what the other businesses do, in that it buys companies. So like it buys entire companies and lets them grow, like fuels them with growth and helps them find things and resources and customers. and then it holds on to them. It's kind of like Warren Buffett's company in the United States, Berkshire Hathaway. It buys entire businesses or just big chunks of other businesses like TPG Telecom, Brickworks. Anyone familiar with Austral Bricks will know that name. And TPG Telecom is a pretty much a household name nowadays. These types of businesses get bought by Soul Pats and they hold them for a very long time.
Mm.
And in doing so, what they do is they kind of capture all of the dividends. The dividends are paid back to the mothership, so to speak, and then reinvested again. But some of it's kept and paid back to shareholders. And this is a company that ticks literally all of the boxes that I mentioned at the top of the show. In fact, all of these companies do. Um, ticks all those boxes. And the key one is it's got a great management team. And if you want more, if you want to learn more about that, I would highly recommend you go and check out a podcast that we've done on the Australian Investors Podcast with a guy by the name of Todd Barlow. Todd Barlow, the Australian Investors Podcast. He's the CEO of the company today.
There's such interesting ones to contrast as well because Soul Pats has so many different businesses doing different things within it. So you are getting diversification just by investing in that. Whereas you also talked about ResMed, which is really focusing on one particular thing.
Yeah, and so the key thing with that is, Kate, that a lot of people focus on companies that are kind of like what I would call gonna companies, like they're gonna do something, they're gonna launch a product, they're gonna expand into Africa, or they're gonna go into the United States. Those are highly speculative companies. And the reality is, all of these companies on this list are the opposite of that. They've been in business for decades, they've been selling products for decades, and there's no like second guessing what they actually do. Now, Soul Pats is a bit of a hard one for people to wrap their heads around because it doesn't have like one defined thing. You and I, Kate, we're recording this from Victoria, but for anyone in New South Wales or even other parts of the country, you might be familiar with Soul Pattinson and Chemists. And they were previously owned by Soul Pats. That's how the business started in Sydney over 100 years ago. But the reality is, over time, the business has morphed and grown well beyond just pharmacies.
Now, what if I wanted to invest in high dividend paying stocks, but I don't want to go around and buy all these individual companies enough to diversify my portfolio? What other options do I have available?
So we think that, and when I say we, I mean like Rask, the brand, think that the best way to do that is through an ETF. And the ETF that stands out in Australia, I'll bring it up, it's the biggest one, is the Vanguard Australian Shares High Yield ETF. The ticker symbol, or the stock code, is VHY. Now, you can use this in two ways. First of all, you can just invest in the ETF and it will go and invest in 60 to 70 different companies on the Australian Stock Exchange. How does it pick those companies? Well, it actually takes analysts' research and puts it all together and goes, which are the companies forecast in the year ahead to pay a big dividend? And it puts all those together. And that's what you end up with when you get the ETF. You get a basket of all of them. And the way they measure that on their website is something called equity yield or dividend yield of 4.7%. So inside of this ETF, you will have a lot of different companies: Commonwealth Bank, BHP, NAB, all the usual suspects. You can keep going down and down the list. Even Wesfarmers is in there. That's the one that owns Bunnings. So that's all in one, Kate. And people like this ETF. There are quite a few dividend ETFs, such as from GlobalX, sponsor of our Australian Investors Podcast, BetaShares, sponsor of our Australian Finance Podcast. And there are quite a few. There's one from Van Eck. There's Russell. There's other ETF providers that do things like this. This is the largest one and the most established one. And the key things that you can see on the page in front of you, if you're watching here, and if you're listening, I'll explain it, is that they estimate that the growth in the profits of all the companies inside this is 6.8%. The dividends, 4.8%. So what they're effectively telling you right here on this page in front of us is, hey, the companies inside are growing and they pay a dividend yield. Because the fear that people would have is, well, you just get all these dividend stocks, but they're not growing. They're just going to go backwards. But no, they're saying, no, we are expecting them to grow and they also pay a dividend. So it's kind of like, the old cheat sheet that you used to have at school where you would like take the formulas into the exam or something like this. This is basically that. It's like, just let them do it and handball it all over to them if you're not interested in picking individual stocks, which is a lot of us, to be honest. Like the VHY ETF is included in our portfolios at Rask Invest. And the simple reason is we have our VAS ETFs, or if anyone's listening to this, you might have A200, STW, IOZ, the list goes on. You might have one of those ETFs. But then for retirees, you can complement that with a bit more income and a similar long-term return by having a dividend-focused ETF. And so, even if you have, say like Commonwealth Bank or your parents, Kate, might have, X, Y, and Z, they can add this to it, knowing that it's diversified, knowing that it's going to be just stable, and knowing that the fee's pretty low too, to be honest.
And if you're a little bit younger, like us, you can also choose to turn on a dividend or a distribution reinvestment plan for most of your shares. Companies sometimes decide not to, but generally they let you, or your ETFs like VHY. And so instead of getting the payment in your bank account twice a year, 4 times a year, it will get reinvested into that ETF. So you get additional units. So that helps it grow over time without you having to do anything. You still have to pay tax. That's a good point to remember, but it does help your investments grow over time and you get to benefit from compound interest.
Yeah, that's it. So that would just be like, instead of taking the dividends as cash, it just gets put back into more investing for you. And you can do that a few different ways, but we mentioned at the top of the show this idea of a share registry. So if you go to an ETF provider's website, you can find out something called the registry. Now, you should have a notification from them to say, hey, you're a new shareholder of this ETF. Here's where you log in. And you can log in there and select DRP. I like the US phrase for this, a DRP, which is called a drip. They call it a drip in the US because it's like drip feeding your investments. And the same for your share investments. Often you can control this at your brokerage level, but otherwise you have to log into your share registry. But just in summary on this, Kate, we have talked about quite a few different companies, some really spectacular companies like ResMed, Cochlear, absolute like world beaters. And we're very lucky to have them here on the Australian share market. BWP Trust is the landlord for many of the Bunnings warehouses, or you can buy the business itself through Wesfarmers, WES. Soul Patts is the diversified one that's kind of like anti-fragile. That's SOL, that's a ticker symbol. And if you prefer ETFs, like we do for the core portfolio, you can go with VHY, which is the dividend yield ETF from Vanguard. We should make a special mention too to say that when we invest at Rask, we have a core and a satellite approach. The core is typically ETFs, and then the smaller investments around the outside are the individual stocks, thematic ETFs, and those types of things. One mistake that a lot of income investors make, besides just picking the one with the highest yield, is just betting on one stock, which is not advisable in any way, shape, or form. Best to be diversified, because even if one goes down, you've still got all the others in your portfolio that should hold up. And that's the beauty of diversification, Kate.
Yes. And if you enjoyed this episode, we're going to do a few more deep dives into ETFs and dividend investing over the next few weeks. We're going to compare ETFs like VDHG versus doing it yourself. We're going to look at how to build a dividend. I can't even speak today. Now, if you enjoyed this episode, we're going to be doing plenty more deep dives over the next few weeks. I've already lined up episodes on comparing ETFs like VDHG, which kind of does everything, versus doing it yourself and building your own ETF portfolio. We're going to look at how you actually build an income generating portfolio, and if you can build a portfolio to the size where you don't have to work again if you don't want to. So there's plenty more to come if you enjoyed this.
Yes, absolutely. And if you do want to take your knowledge to the next level, Kate, we're celebrating because we just passed 30,000 students enrolled in Rask courses. So you may know that we're on a mission to 100,000 into our free courses, and we're 30% of the way there, if my math's correct. And to celebrate, what we've done recently is we're giving away our Value Investor Program, the original one. So there's two of them. The original one, which when it first launched, it was $799. It's now free, and it takes you through how to pick all different types of companies, shares, how to research them, some of the tools, gives you valuation templates, tutorials, videos, you name it, it's all in there, and it's now totally free. So we'll put a link in the show notes. If you're an absolute beginner, our ETF investing course is free as well, as is our Shares for Beginners course, also free. So many good courses in there, and they're all free. So we'll link to those in the show notes. It actually does help support us towards our goal if you enroll or you share them with a friend, even though they're free. So that's it, Kate. That's the special at the end of this episode. We'd love to see you enrolling in a course and letting us know what you think.
Amazing. Well, thank you everyone for listening today.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.